Here's a shocking truth. By 2026, nearly 10 million American seniors could see their pensions vanish or be cut in half. That means years of hard work, loyalty, and retirement planning could disappear in the blink of an eye. Imagine waking up one morning expecting your monthly check only to discover it's been slashed, or worse, gone completely. How could something so important, something people trusted their entire lives, be hanging by a thread? The answer lies in a mix of broken promises, financial mismanagement, and economic pressures that very few people are talking about. In this video, we'll uncover the 10 hidden reasons behind this looming crisis and why it could change retirement forever. Number 1. Underfunded pension plans. Let's start with one of the biggest reasons millions of seniors may lose their pensions: underfunded pension plans. For decades, many companies and even state governments have failed to put in enough money to cover the promises they made to workers. On paper, everything looks fine. Workers are told, "Don't worry, your pension is safe." But behind the scenes, the math doesn't add up. Imagine saving for retirement, but instead of putting in the full amount every year, you only put in half. Eventually, when it's time to retire, the money just isn't there. That's exactly what's happening to countless pension funds across America. The numbers are alarming. Reports show that some pension funds are only 60 to 70% funded, meaning they already owe far more money than they actually have. This is like a sinking ship with too many passengers and not enough lifeboats. Seniors who believed their pensions were secure may soon find themselves facing sudden cuts, delayed payments, or even complete loss of income. For many, that pension isn't extra money, it's their entire retirement safety net. The real danger is how quickly this problem can spiral. If the economy takes a downturn, or if more retirees start drawing from these already strained funds, the shortfall could explode. And the worst part? Most workers never even know their pension is underfunded until it's too late. By the time the letters arrive in the mail saying benefits are being reduced, decades of trust and planning have already been destroyed. This is why underfunded pension plans are often called a silent time bomb. And unfortunately, it's ticking louder every single day. Number 2. Rising life expectancy. Another major reason pensions are under pressure is something that at first sounds like good news. We're living longer than ever before. Just a few generations ago, the average American lived into their mid-60s or 70s. Today, many people are living well into their 80s, 90s, and even past 100. While this is a remarkable achievement of modern medicine and healthier lifestyles, it also creates a financial challenge that most pension systems were never designed to handle. Think about it this way. Many pension plans were built on the assumption that retirees would collect payments for maybe 15 to 20 years after leaving the workforce. But now, retirees may live 25, 30, or even 40 years in retirement. That means millions of extra pension checks must be paid out without the pension funds having built up the extra money to cover them. For every additional year of life, the strain on these funds grows heavier, stretching resources thinner and thinner. This rising life expectancy also creates ripple effects. More seniors living longer means more people drawing from pensions at the same time, while fewer younger workers are contributing to replace that money. It's like having a bucket with more holes than water going in. The bucket eventually runs dry. And unlike Social Security, which at least has some level of federal support, many pension systems rely solely on employer contributions and investment returns. Without major changes, the blessing of longer life could turn into a nightmare of financial insecurity for millions of seniors. Number 3. Corporate bankruptcies. Another silent killer of pensions is corporate bankruptcies. Over the past few decades, we've seen once mighty companies collapse almost overnight: airlines, steel giants, retail chains, and more. When a company files for bankruptcy, pension obligations often end up at the very bottom of the priority list. Creditors, debts, and restructuring usually come first, leaving loyal employees who spent decades working for that company holding nothing but broken promises. In many cases, retirees end up receiving only a fraction of what they were promised, sometimes pennies on the dollar. For example, thousands of airline employees saw their pensions slashed when their companies restructured, even after years of service and sacrifice. And it doesn't just affect people already retired. Workers close to retirement may suddenly discover that what they counted on is gone, forcing them to scramble for second jobs or delay retirement altogether. The terrifying part is that no industry is immune. Even stable-seeming corporations can face financial crises from global competition, technological disruption, or economic downturns. For seniors who trusted their employers, a bankruptcy doesn't just wipe out a paycheck. It can destroy their entire sense of financial security. And with more companies facing rising debt and shrinking profits, the risk of pensions disappearing through bankruptcy grows every single year. We put a lot of research and effort into creating videos like this, and your support means everything. So, if you found this eye-opening, take a second, just one click, to subscribe, and tell us in the comments, do you think pensions will survive the next decade, or are they already a broken promise? Number 4. Shifts from pensions to 401ks. One of the less obvious but equally damaging reasons pensions are disappearing is the shift from traditional pensions to 401k-style plans. Decades ago, pensions were the standard benefit for hardworking Americans. Companies promised a guaranteed monthly check for life after retirement. But starting in the 1980s and accelerating in the 1990s, corporations realized that pensions were expensive to maintain. So, they began replacing them with 401ks and other defined contribution plans, which shift the responsibility of saving for retirement from the employer to the employee. At first glance, this might not sound terrible. After all, 401ks give people more control over their savings. But here's the catch. 401ks are tied to the stock market, which means retirement security now depends heavily on investment performance. Unlike pensions, they don't promise lifetime income. Many workers don't contribute enough, or they start saving too late, leaving them with accounts far too small to sustain a comfortable retirement. And when companies stop funding pensions altogether, the older pension pools shrink and weaken, leaving retirees with less stability. This shift also means that the so-called safety net for seniors is slowly unraveling. Instead of knowing they'll receive a fixed payment for life, retirees must now manage their own money, watch the markets, and hope they don't outlive their savings. For millions of seniors who expected a pension, this transition is like the ground being pulled out from under their feet, an invisible but powerful force pushing pensions toward extinction. Number 5. Poor investment decisions. Another ticking time bomb inside the pension system comes from poor investment decisions. Pension funds don't just sit on piles of cash. They invest that money in the stock market, bonds, real estate, and sometimes even risky ventures. The goal is to grow the fund so there's enough to pay every retiree for decades. But when those investments fail, it's not the fund managers who suffer. It's the retirees who trusted their pensions would be safe. History is filled with painful examples. During the 2008 financial crisis, some pension funds lost billions almost overnight because they had poured money into risky mortgage-backed securities. Others invested heavily in volatile tech stocks during the dot-com bubble, only to watch the value collapse. While some funds do recover, many never fully bounce back, leaving massive funding gaps that workers ultimately pay for in reduced benefits. The problem is that pension managers are often under pressure to chase higher returns. With interest rates low and obligations rising, they take bigger risks, hoping to cover growing shortfalls. But high-risk gambles can backfire quickly, especially during economic downturns. And unlike individual investors, pensions don't have the luxury of waiting decades for the market to recover. They need steady, reliable income today. That's why bad investment strategies are one of the most dangerous threats to pensions, quietly draining funds that millions of seniors depend on for survival. Number 6. Economic downturns, inflation. Pensions don't exist in a vacuum. They're deeply tied to the health of the overall economy. When recessions hit, companies make less money, workers lose jobs, and contributions into pension funds shrink. At the same time, the value of pension investments can collapse. This creates a dangerous double hit, less money going in and less money growing inside the fund. History has shown this pattern again and again, most recently during the Great Recession of 2008, when pensions across the nation took devastating losses that some are still struggling to recover from today. On top of recessions, there's another silent enemy, inflation. Even if a pension keeps paying the same monthly amount, rising prices mean that check buys less and less each year. Seniors who thought their pension would cover rent, groceries, and medical bills now find themselves forced to cut back on essentials. And unlike Social Security, which sometimes offers cost of living adjustments, most pensions do not automatically increase with inflation. The result? Retirees slowly watch their financial security shrink before their eyes. Looking ahead, economists warn that the combination of economic downturns and high inflation could devastate pensions even further. If another major recession strikes before 2026, already underfunded pension systems could collapse under the pressure. For seniors depending on those monthly checks, that could mean the difference between living comfortably or not being able to make ends meet at all. It's a harsh reminder that even forces outside a worker's control, like global recessions or rising prices, can quickly erode the promises made to them after decades of hard work. Number 7. Government mismanagement. Another powerful reason pensions are at risk is simple but devastating: government mismanagement. Public pension systems, especially at the state and city levels, have been mishandled for decades. Instead of making full contributions each year, some governments have delayed payments, borrowed against pension funds, or used them as political bargaining chips. On paper, the promises sound generous. In reality, the money to back those promises often isn't there. Take states like Illinois and Kentucky, for example. They've been highlighted repeatedly for having some of the most underfunded pension systems in the country. Why? Because politicians often prioritize short-term budget fixes over long-term stability. Skipping contributions today may look good in the headlines, but it leaves a hole that only grows larger with time. By the time retirees are ready to collect, the gap between what's promised and what's available can be billions of dollars wide. The tragic part is that many workers in these systems, teachers, firefighters, police officers, don't even have Social Security to fall back on. Their pension is their only retirement lifeline. When governments mismanage these funds, it's not just numbers on a page being lost. It's the security of people who dedicated their lives to public service. And unless drastic reforms are made, many state and city pensions could run dry within just a few years, leaving seniors with only a fraction of what they earned. Number 8. Lack of federal protections. Many people assume that if their pension fails, the federal government will step in and make sure they still get paid. Unfortunately, that's not always the case. While there is an agency called the Pension Benefit Guaranty Corporation, PBGC, that acts as a safety net, even it has serious limitations. The PBGC only covers certain types of pensions, and even then, the payouts are often far less than what retirees were originally promised. For someone expecting $3,000 a month, that might drop to less than half. The bigger concern is that the PBGC itself has been underfunded for years. Experts have warned that if several large pension systems collapse at the same time, the PBGC may not have enough resources to rescue them all. That means millions of seniors could fall through the cracks, left with little or no federal protection at all. In other words, the safety net may not be strong enough to catch everyone. This lack of reliable federal backing is what makes the pension crisis so dangerous. Unlike Social Security, which is supported by ongoing payroll taxes, pensions depend heavily on the health of individual companies or state systems. If they fail, the government isn't guaranteed to save them. For retirees who believe their pensions were as solid as Social Security, the reality can be shocking. The safety they counted on simply doesn't exist. Number 9. Shrinking workforce contributions. Pension systems work a lot like a chain. Today's workers contribute money, which helps pay the retirees who are already collecting benefits. But here's the problem: the chain is breaking. In many industries, there are fewer young workers paying in and more seniors drawing out. This imbalance puts enormous strain on pension systems that were built on the idea of steady population growth and stable employment. Consider the shift in demographics. As the baby boomer generation retires in massive numbers, the younger workforce simply isn't large enough to keep up with the financial demands. On top of that, the rise of contract work, freelancing, and gig jobs means fewer workers are even part of traditional pension systems. The result? Less money flowing in while more money flows out, a recipe for collapse. This shrinking base of contributors creates a dangerous feedback loop. With less money coming in, pension funds are forced to take on more risk, cut benefits, or raise contribution requirements for current workers. None of these solutions are sustainable long-term. If the imbalance continues, many pensions may run dry far sooner than expected, leaving seniors with little more than broken promises. For retirees who thought the system would support them, the harsh reality is that the system itself is running out of people to keep it alive. Number 10. Delayed action on reforms. Perhaps the most frustrating reason pensions are in danger is delayed action. Experts have been sounding the alarm about underfunded pensions for decades, yet real reform rarely happens until it's almost too late. Politicians often avoid the issue because fixing pensions requires tough choices, like raising taxes, cutting other programs, or reducing benefits. Instead, they kick the can down the road, hoping the problem will magically solve itself. The trouble is, time only makes things worse. Every year of inaction allows pension shortfalls to grow larger and harder to fix. What might have been solved with modest adjustments 20 years ago now requires massive cuts or bailouts. Seniors who had nothing to do with the political games end up paying the price for decades of neglect. This lack of urgency has created a ticking clock. Unless reforms are made soon, by 2026, millions of retirees could face sharp benefit reductions or even complete loss of pensions. It's not just a financial issue, it's a matter of trust. Workers spent decades believing in promises that leaders never truly prepared to keep, and now the consequences of that delay are coming due. The pension crisis is not just about numbers on a balance sheet, it's about people's lives. Millions of hardworking Americans have spent decades building companies, teaching children, keeping communities safe, and serving their nation with the promise that their retirement would be secure. Yet today, that promise is hanging by a thread. From underfunded plans and risky investments to inflation, bankruptcies, and political delays, the challenges are stacking up fast. If nothing changes by 2026, countless seniors could find themselves with far less than they were guaranteed, or with nothing at all. And that means not only financial struggles, but also the loss of dignity, security, and peace of mind in retirement. It's a future no one wants, but one we can't afford to ignore. While the outlook may seem grim, solutions do exist if action is taken quickly. First, stronger funding requirements must be enforced. Companies and governments need to contribute the full amounts required each year, rather than delaying or skipping payments. Second, pension funds should adopt smarter investment strategies that focus on long-term stability rather than chasing short-term, high-risk returns. Reliable, steady growth may not look flashy, but it ensures funds don't collapse in downturns. Third, policymakers need to introduce reforms at the federal and state levels. This could include offering greater protection through the Pension Benefit Guaranty Corporation, implementing cost-of-living adjustments to combat inflation, and creating stronger safeguards against corporate bankruptcies, leaving retirees empty-handed. At the same time, workers must be given more education and transparency about the true state of their pensions so they can plan better for retirement rather than being blindsided at the last moment. Finally, it's about balance. Younger workers need incentives to participate in these systems, ensuring a healthier cycle of contributions and payouts. At the same time, retirees should be protected from sudden drastic cuts that destroy the very trust pensions were built on. If these steps are taken now, before the clock runs out, millions of seniors can still enjoy the secure retirements they earned through decades of hard work. The time to act is now. We put countless hours into researching and producing videos like this to bring you the truth that often gets overlooked. So please show your support. It's just one click to subscribe. And before you go, watch our previous video for more insights that could change the way you see retirement. Finally, share your thoughts in the comments. Do you think pensions can still be saved, or is it already too late?